Technical analysis made easy, a starting place for new traders. One of the fundamental principles of technical analysis is that history tends to repeat itself, and that idea can best be illustrated in chart patterns. Human brains are good at pattern recognition and memory, so chart patterns are easy to spot in a historical chart. Once you have identified a pattern, you can visually backtest that pattern by noticing how price reacts after that pattern is completed and confirmed. Chart patterns. Chart patterns are unique bar formations that identify a possible trading opportunity. There are dozens of recognized chart patterns that traders can employ to help signal potential trend reversals or price breakouts. Chart patterns can be as simple as an inside bar or as complex as a multi-bar head and shoulders. In this video, we will focus on three popular chart patterns: price pivots, key reversals, and opening gaps, to help get you started with technical chart patterns. Price pivots. Price pivots are multi-bar patterns that can help detect turning points in the market. The pattern is identified based on the number of bars to the left and right of a significantly higher high or lower low, generally at the end of a significantly trending move higher or lower. The parameters for a pivot pattern include the number of bars to the right and bars to the left of a higher high or lower low price pivot point. Let's say we set up our pivot pattern parameters to look for a price pivot with 8 bars to the left and 3 bars to the right. Once we have 8 lower lows, followed by 3 higher lows, our pivot up pattern is complete. And once we have 8 higher highs and 3 lower highs, the pivot down pattern is complete. Pivots often occur at the end of the current trend, but can also appear in the middle of a trend as a pullback, and then the trend continues in the previous direction. This would be considered a false pivot, as there is no new directional follow-through, and the market returns to the previous trend, making new highs or new lows. It is important to note that the pivot pattern is not complete until the right side parameter rule is met, which means the market has reversed for several bars from a higher high or lower low before you get the actionable pivot pattern signal. Price pivots can be a valuable tool that can be used on any bar interval to help you identify the current trend and potential trend reversals. Key reversals. Key reversals are 2-bar patterns that can help detect a short-term change in market trend direction. The patterns form after an observable downtrend or uptrend, generally used on daily charts to provide short-term swing trading opportunities that last a few days. Key reversals have a variety of utility on many different time frames. We will look at the basic key reversal pattern here, but keep in mind that the key reversal pattern often has slightly different rules depending on who you ask. A key reversal up pattern starts in a downtrend. Then the key reversal bar, current bar, makes a low that is lower than the previous bar, and then the close of the key reversal bar, current bar, is greater than the close of the previous bar. This can often create an outside engulfing bar. Orders are generally placed slightly above the high to help confirm the new direction. A key reversal down pattern starts in an uptrend. Then the key reversal bar, current bar, makes a high that is higher than the previous bar, and then the close of the key reversal bar, current bar, is lower than the close of the previous bar. Again, this can often create an outside engulfing bar. And here, orders are generally placed slightly below the low to help confirm the new direction. Very similar to pivot points, the stronger or longer the current trend, generally the higher the probability of the key reversal signal direction. Opening gaps. In today's world of 24-hour Globex markets, a trader might think that the concept of opening price gaps may be an obsolete subject. And although it is true that extended market hours have reduced the number of opening gap opportunities, there are still many agricultural commodity futures that don't trade overnight. Gaps generally occur when there is an order imbalance at the open of the session, often caused by news, high volume, or high volatility around the close of the previous session. Gaps can also occur when a market is trading limit up or limit down, which can be a challenging time to take a new position. A gap on a chart occurs when prices jump significantly up or down from the previous closing session. A gap pattern requires the low of the current bar to be above the high of the previous bar, gap up, or conversely, the high of the current bar to be below the low of the previous bar, gap down. Some traders also consider gaps based on the proximity of opening and closing prices. There are two common ways traders look for opportunities in opening gaps. First is the exhaustion gap, where the price gap expends most or all of the built-up buying or selling pressure, and then market price actions reverses back to the previous bar. This is called filling the gap. Another way traders look at gaps is the continuation or breakaway gap, where market prices continue in the same direction as the opening gap, often when a market has consolidated for one or more days and there is a buildup of buying or selling pressure at a certain price level. That pressure can create a breakaway gap. Or if a market has been in a multi-day extended trend, the opening gap may just be a continuation of that trend. Thank you for watching this segment on price patterns. We've only really skimmed the surface here, but we hope that you have found this to be a good start. Make sure to watch any of the videos you may have skipped in this series and visit this space often as new content is being added all the time.